Welcome to the Deep Dive, where we take complex information, distill it down, and really help you understand what truly matters.
hmm
Today, we're embarking on a fascinating deep dive into a company that really highlights this tension between incredible scientific breakthroughs and, well, stark financial realities.
That's right.
Mustang Bio, Inc. It trades under the ticker MBIO. We've taken an expert-level value investing analysis report, plus their most recent news, and we're going to unpack it all for you.
Yeah, it's quite the story.
This company, MBIO, it presents a classic dilemma, you know? Groundbreaking scientific potential, we're talking cell therapies here, colliding head-on with extreme financial precarity.
Absolutely.
The analysis we've looked at, it ultimately lands on a very clear recommendation. It might actually surprise you, given the potential ups and downs you just mentioned.
It probably will.
But it's a conclusion rooted really deeply in the principles of capital preservation.
It's a powerful case study, it really is. You see the promise of these truly transformative cell therapies for, devastating diseases like glioblastoma.
Right.
And then you have to square that with the harsh realities of biotech financing, market dynamics. It forces us to understand what value truly means.
Beyond just the exciting science.
Exactly. Beyond just the breakthroughs, our goal today is to connect all these dots for you, help you see not just what this company does, but why its current situation matters so much.
Yeah, especially if you're looking at these high-stakes investments. Our mission today is really to guide you through this complex landscape. We want to highlight the critical insights, the surprising facts that emerge when you actually go beyond the headlines. So let's unpack this.
Let's do it.
Okay, so to truly understand Mustang Bio, we need to lay some groundwork first. We'll start with part one, the foundation. This covers their business, management, and financials.
Makes sense. Got to build from the ground up.
Exactly. So we're kicking things off with chapter one, business and scientific analysis. Mustang Bio, founded back in 2015 by Fortress Biotech. They operate as a clinical stage biopharmaceutical company.
Right. Clinical stage is key here. No approved products yet.
And their strategic focus is on cell and gene therapies for these really difficult to treat cancers. Now, here's where it gets really interesting for their business model. They use an in-licensing strategy.
That's right. So instead of the hugely expensive, time-consuming process of early-stage drug discovery, Mustang acquires the rights. They get them from promising technologies at leading institutions like City of Hope, Nationwide Children's Hospital, Fred Hutchinson.
Big names.
Yeah, top-tier places. But this means their entire success hinges on two things. One, the scientific merit of these licensed assets.
Makes sense.
And two, maybe even more crucially, their ability to secure the enormous capital needed to advance them through these incredibly expensive, multi-phase clinical trials.
So they're basically picking potential winners and then trying to fund the whole race themselves.
That's a good way to put it.
Okay, let's talk about their most ambitious program, MB109. This targets glioblastoma, or GBM. For those who might not know, GBM is the most common and, sadly, the most lethal form of adult brain cancer. The 5-year survival rate is grim, like 5%.
Horrible odds.
And the market for treating this, it's projected to reach over $5.68 billion by 2033. So huge need, huge potential market.
Definitely.
Now, MB109 is a combination therapy. It uses MB101, which is a CAR T therapy, and MB108, which is an oncolytic herpes simplex virus. Could you maybe quickly break down what those are, CAR T, oncolytic virus?
Sure, yeah. Think of CAR therapy like MB101 as kind of retraining the body's own immune cells, specifically T cells.
Okay.
You engineer them to become like super soldiers designed to recognize and destroy cancer cells. If personalized, uses the patient's own cells.
Got it. And the virus part, MB108.
Right. MB108, the oncolytic virus, is a modified virus. It's designed to selectively infect and kill tumor cells, but it also stimulates an immune response.
Okay, that's really powerful stuff. And the scientific rationale for putting these two together is pretty innovative.
It is. See, most solid tumors, GBM included, are often described as cold.
Cold, meaning?
Meaning they lack significant immune cell infiltration. It's like the immune system soldiers can't really get into the tumor fortress.
Right, like trying to fight a war when your soldiers can't even find the enemy base.
Exactly. So Mustang's strategy is to use MB108 first.
The virus first.
Yeah. It infects and destroys tumor cells, and that process triggers an inflammatory alarm. It basically primes the tumor microenvironment, makes it hot. Ah, okay. So it makes the hidden fortress visible and accessible.
Precisely. Only then do they administer the MB101 CRT. cells, the super soldiers.
which can now effectively rush in and attack because the environment's been prepped.
Exactly.
And we have seen some compelling, albeit preliminary, proof of concept for this, right?
We have. There was a phase 1 clinical trial of MB101 just by itself as a monotherapy, published in Nature Medicine, which is a top journal.
Very prestigious.
Yeah, it achieved stable disease or better in 50% of heavily pretreated patients. And this included 2 really remarkable, durable, complete responses. One lasted 7.5 watt, the other is still ongoing at 66 plus months. Wow, 66 months ongoing. That's incredible.
It really is. And what's key here is that these exceptional responses were in patients whose tumors were already intrinsically hot.
So it validates MB101's potency when it can access an inflamed environment. It supports the combo idea.
Precisely. It strengthens the rationale for the MB108 priming step.
Okay. And what's particularly striking, you mentioned recent news.
Yes, a pivotal catalyst just happened. On July 7, 2025, the U.S. FDA granted orphan drug designation, ODD, to MB101.
Orphan drug designation, what does that mean practically?
Well, it's not just scientific validation, though it is that too.
Yeah.
It's a significant de-risking event from a regulatory and commercial standpoint. It offers things like tax credits, fee waivers.
Okay, helpful for cash.
Very helpful. And most importantly, 7 years of market exclusivity if it gets approved.
7 years, that's huge.
It absolutely is. It strengthens the entire regulatory and commercial position of the combined MB109 program significantly.
Okay, so that's GBM. But beyond that, Mustang is also diversifying its pipeline a bit with MB106. What's that one?
Right, MB106. This is a CD20 targeted CAR-T therapy. It's for B-cell non-Hodgkin lymphomas, NHL, and chronic lymphocytic leukemia, CLL.
Okay, different cancers, different target.
Exactly. And early data here has also been highly encouraging. They reported a 94% overall response rate in follicular lymphoma.
94%, that's very high.
Extremely high. This program provides crucial pipeline diversification. And it has a distinct competitive advantage, too.
How so?
Its target, CD20, is important because it could potentially treat patients who have relapsed after the existing CD19-targeted CAR-T therapies. Drugs like Yescarta and Kymriah.
So it could fill a gap for patients whose first CAR-T treatment stopped working?
Precisely. Plus, its safety profile looks favorable so far. It might even allow for outpatient administration, which would be a massive commercial advantage. Think lower costs, more convenience.
Definitely. Less burden on the hospital system, too.
Right. And they've even announced plans to expand MB106 into autoimmune diseases like lupus. That could open up a much, much larger market down the road.
Wow. Okay. So potential beyond cancer, too. The CRT market itself, it's exploding, right?
Oh, absolutely. Projections are huge. Anywhere from $15 billion to maybe even $127 billion by the early 2030s. It's a transformative area.
So how does Mustang fit into that competitive landscape? In GBM, you said their combo is unique.
Yeah, in GBM, while there's competition from other CAR-T approaches, Mustang's oncolytic virus combination is a key differentiator. It's a novel strategy.
And for the lymphomas with MB106.
For B-cell lymphomas, MB106 seems strategically positioned for that post-CD19 relapse segment. Rather than trying to compete head-to-head with the established therapies right away, it's finding its niche.
Makes sense. Okay, moving on to the human element then. Let's explore Chapter 2, Management and Governance Evaluation. For any clinical stage biotech, leadership is absolutely critical.
Couldn't agree more. Execution is everything.
And Mustang Bio seems to have a significant asset in its CEO, Manuel Lichman, MD. He's been there since 2017.
His background is incredibly relevant. Seriously impressive. He spent over 18 years at Novartis.
Novartis, okay. Big pharma.
Yeah, and he culminated his time there leading the CTL019 program. That program led directly to Kymriah.
Kymriah, one of the very first approved CAR-T therapies ever.
Exactly. So this isn't just generic biotech experience. It's rare, specific expertise in navigating the incredibly complex clinical, manufacturing, and regulatory challenges unique to CAR-T.
So he knows the playbook because he helped write it.
Pretty much. This provides a level of execution capability you just don't often see in a microcap company.
That is an impressive resume, no doubt. But, and here's maybe the tough question. In a microcap biotech that seems to be, as we'll see, on the financial brink, can even a top-tier CEO like Dr. Lichman overcome those immense financial challenges?
That's the million-dollar question, isn't it? Or maybe the multi-million-dollar question they need.
Right. What are the practical limits of even his deep expertise in this specific context?
And that brings us neatly to the company's governance. You really can't separate Mustang Bio from its founder and major shareholder, Fortress Biotech.
Ah, yes, the founder relationship. How does that play out?
Well, Mustang's board is deeply intertwined with Fortress. Fortress's chairman and CEO also serves on Mustang's board.
Okay.
This Fortress model, as they call it, is kind of a double-edged sword.
How so?
On one hand, Mustang gets access to sophisticated capital markets, expertise, infrastructure, stuff a small company might not have.
That sounds like a plus.
It can be, but on the other hand, it creates significant potential for conflicts of interest.
Ah, like whose interests come first?
Exactly. An investor has to question whether strategic decisions will truly maximize value for all MBIO shareholders, or if they might benefit the broader Fortress ecosystem instead.
Yeah.
That's a material risk for a value investor.
Definitely something to watch. Now, looking at insider and beneficial ownership, Fortress Biotech's stake, it dropped dramatically, didn't it? From over 36% down to just 7.9% as of April 2025.
Yeah, a huge drop, largely due to a 1-for-50 reverse stock split back in January 2025.
Okay, a reverse split. And Fortress's stake shrinking. What does that tell us?
Well, the reduced stake suggests massive dilution, likely from financing rounds where Fortress didn't put in more money to maintain its pro rata share. They let their ownership percentage get diluted.
Okay.
But what's maybe even more telling, for a value investor at least, is the near total absence of any significant open market purchases by insiders, especially the CEO.
During a time when the stock was really low.
Exactly, when it was severely depressed. For a company supposedly on the cusp of major value creation, this lack of insider buying is a really stark data point. It kind of suggests a lack of conviction from those who know the most.
Yeah, that silence can be pretty loud sometimes. Okay, so we got the science, the leadership. The critical question now becomes, can they actually afford to keep this innovation engine running?
The money question.
Right. Let's dive into Chapter 3, Financial Analysis and Valuation. And fair warning, this picture is quite stark.
Understatement, perhaps.
An analysis of Mustang Bio's financial position as of March 31st, 2025. It reveals extreme distress. They reported only $14.23 million in cash and cash equivalents.
Which sounds like a lot, but...
But their total liabilities were $11.3 million, so not a huge cushion there.
And the most critical aspect is their cash runway. Their cash burn rate, the negative operating cash flow, was $7.48 million just for that quarter.
Just for Q1?
Yeah. So simple math. $14.23 million cash, burning almost $7.5 million a quarter. That gives them enough capital for approximately 1.9 quarters from the end of Q1 2025.
1.9 quarters, so less than 6 months, which means as of today, July 7th, 2025.
They were operating with only a few months of cash left, maybe less. This isn't just concerning, it's an immediate existential crisis.
Right.
That recent orphan drug designation we talked about, it wasn't just scientific validation, it was absolutely a crucial lifeline. They needed that news to have any hope of attracting the survival capital required just to keep the lights on.
Wow. So they're pre-revenue, no sales coming in yet.
Correct.
And they have this history of persistent, substantial net losses.
Yeah.
It peaked at negative $77.5 million back in 2022.
Huge losses.
To fund these losses, they've repeatedly issued equity shares, which leads to catastrophic dilution for existing shareholders. The number of shares outstanding increased by an astonishing 592.16% in the year prior to July 2025.
592%.
Yeah. It's like, for a shareholder, it's like running a marathon only to find out you've actually run a few laps backward because your slice of the pie keeps getting smaller and smaller.
That's a painful analogy, but accurate.
Yeah.
And that 1-for-50 reverse stock split in January 2025, that just highlights the distress further.
Why do companies do those reverse splits again?
They're typically a cosmetic fix, honestly. Usually done to boost the share price above minimum listing requirements, like $1, to avoid getting kicked off major exchanges like the NASDAQ.
So it signals severe and prolonged stock price depreciation.
Exactly. For a value investor, these are all bright red flags flashing financial distress. Now, obviously, traditional valuation methods like discounted cash flow, they just don't work here.
Because there are no current cash flows to discount.
Right. You can't discount zero.
So the analysis uses something called a risk-adjusted net present value, or RNPV, approach. Why is that the only suitable method here, and what's it trying to do?
Great question. The RNPV approach models potential future cash flows from their drug programs if they succeed. But here's the critical twist. It discounts them back not just for the time value of money, but also using a probability of success factor for each clinical stage.
Ah, okay. Factoring in that huge failure rate we talked about.
Exactly. It's really the only way to try and quantify potential value for a biotech with zero revenue today and highly uncertain future cash flows. The whole investment case here hinges on whether the current market cap, just $5.21 million, offers a sufficient margin of safety given that potential future value, however risky.
5.2 million market cap. That seems incredibly low for a company with potential cancer therapies.
It is. And here's the fascinating paradox, right?
Yeah.
A single successful orphan oncology drug can literally generate billions in revenue. Billions. So mathematically, it's plausible there's a massive valuation gap between Mustang's tiny market cap today and its theoretical potential value down the road.
Yeah.
That makes it look quantitatively cheap.
Cheap if it works.
If it works. And this is a huge, but you have to weigh that against the extremely high probability of clinical failure and the absolute certainty of more future dilution.
Because even if the science looks good, they need money to finish the trials.
Tons of money. The RNPV model has to make assumptions like $450,000 per treatment price, maybe a 12–15% overall probability of success from here to approval.
Which is actually quite optimistic historically.
It is. And critically, the model also has to estimate the future dilution needed. The analysis estimates around $200 million in future dilution might be required just to fund these trials through to potential approval.
$200 million dilution on top of a $5 million market cap today. That's huge.
It's an enormous hurdle for current shareholders.
Okay. We've covered the business, the management, and that stark financial picture. Now let's transition to part 2, market, risks, and the final verdict.
All right.
Let's kick off part 2 with chapter 4, market sentiment and analyst coverage. Mustang Bio stock.
It really epitomizes speculative trading, doesn't it?
Oh, absolutely. Textbook example.
On July 7, 2025, the day they got that orphan drug designation news, one source reported a closing price of $5.70. That's like a nearly 380% gain in one day.
Crazy volatility.
But then the company's own investor relations site and other financial portals, they reported a closing price of just $1.19. What's going on there? Is that just bad data?
Probably not a data error. It's more likely a clear reflection of a massive news-driven intraday spike that subsequently faded. A pump and dump maybe, or just extreme short-term trading.
Ah, so it shot up on the news and then crashed back down before the market closed.
Seems likely. It perfectly underscores the stock's extreme sensitivity to any clinical or regulatory news, and its popularity among short-term traders just looking for a quick pop. So for fundamental valuation, that $1.19 closing price is the one that matters.
That's the relevant figure, yeah. And the long-term trend tells the real story. A 52-week range from $0.89 way up to $27.25.
Wow.
And a one-year price change of negative 95.74%. That screams deep market concerns and the brutal impact of all that past dilution we discussed.
Minus 95% in a year. Ouch. Yet despite that, the analyst consensus from the small group covering them, like 5 sell-side analysts, firms like H.C. Wainwright, Cantor Fitzgerald, it's overwhelmingly positive.
Right, lots of buyer overweight recommendations.
And their price targets range from $4 all the way up to $16. That implies huge potential upside from $1.19. How should a value investor interpret those targets?
Yeah, this raises a really important question.
Sure.
For a true value investor, these high-priced targets need to be viewed with extreme skepticism. Extreme.
Why skeptical?
Because they're based on models that have to assume very high degrees of future clinical and commercial success. They effectively ignore the very real, very near-term bankruptcy risk. And they definitely ignore the certainty of future dilution.
So they're painting the best-case scenario.
Exactly. The wide dispersion of the targets themselves from $4 to $16 that further highlights the profound uncertainty here. They indicate blue-sky potential much more than they indicate a realistic, risk-adjusted intrinsic value. It feels more like a promotional piece than a sober assessment for someone focused on preserving capital.
Got it. Okay, let's dive into Chapter 5, ownership structure. Who actually owns this company? Because the composition of the shareholder base can tell you a lot.
It really can. And for Mustang Bio, the institutional ownership data sends a pretty clear and frankly cautionary signal.
How so?
Total institutional ownership is exceptionally low.
Yeah.
Depending on the source, it's somewhere between 3.22% and maybe 9.82%. Really low for a public company.
That is low. Who are the big holders then?
Well, the largest holders, like UBS Group AG, they hold absolutely minuscule positions. UBS's leading stake, for example, was valued at only $59,000.
$59,000, that's pocket change for a firm like UBS.
Exactly. And crucially, the shareholder list is basically devoid of top-tier, dedicated biotechnology specialist funds.
The smart money in biotech isn't there.
That's the implication. This is a significant red flag. These sophisticated investors, the ones with teams of scientists who live and breathe this stuff, they've likely evaluated the opportunity.
And passed.
It appears so. They likely concluded the risk-reward profile is unfavorable. They probably deemed the financial and dilution risks to outweigh the scientific promise, however exciting it might be.
So who owns it mainly?
It's primarily owned by its founder, Fortress Biotech, even with their reduced stake, and retail investors, everyday traders.
Okay. And the public float is quite small, too, you mentioned. Around 3.33 million shares.
Yeah, very small float. And that small float, combined with the low institutional ownership and the high retail interest, it creates a perfect storm for extreme share price volatility.
Like we saw on July 7th.
Exactly. This ownership structure is really the hallmark of a speculative trading vehicle, not what you'd typically see in a stable long-term investment.
Okay, that makes sense. Now we move to arguably the most crucial part of any investment analysis, Chapter 6, risk assessment.
Yep, got to face the risks head on.
And for Mustang Bio, these risks are, well, they're numerous, significant, and in some cases pretty much existential.
That sums it up well. The most immediate, the most overriding risk is financial and dilution risk. We'd classify this as critical.
Critical. Why?
Because the company's low cash balance and high quarterly cash burn mean it's perpetually on the brink of insolvency. Its ability to continue as a going concern, to even stay in business, is entirely dependent on raising new capital immediately.
And that new capital.
That financing will, without question, come at the cost of substantial dilution for current shareholders. We saw that with the 592% increase in share count year over year. It's unavoidable.
So even if the science miraculously succeeds down the road,
your individual stake, your piece of the company, is likely to be significantly eroded, maybe wiped out, before you ever see a return. That's the critical financial risk.
okay. Then there's clinical and regulatory risk.
Right. Both MB109 and MB106 are still in early to mid-stage clinical development, phase 12.
And the odds there.
Historically, the probability of failure at this stage exceeds 85%. The vast majority of drugs fail here.
85% failure rate. Ouch.
Yeah. And while their cold-to-hot strategy for solid tumors is elegant scientifically, it remains unproven in large controlled trials. That's the hurdle. Plus, safety and toxicity, things like cytokine release syndrome, that serious inflammatory response, are persistent concerns for all CAR-T therapies.
So high science risk, high safety risk. What else?
Well, Mustang Bio doesn't operate in a vacuum. The competitive and market risk is immense.
We touched on this, the big players.
Exactly. The CAR-T space is already dominated by large, well-capitalized pharmaceutical giants. Gilead, Novartis, Bristol-Myers Squibb.
Behemoths.
Yeah. Mustang is a tiny microcap company trying to compete against these industry behemoths with vastly more resources. And the pace of innovation is incredibly rapid, meaning a competitor could develop a superior therapy tomorrow. Maybe an off-the-shelf allogeneic CAR-T that doesn't require personalized manufacturing. That could potentially make Mustang's personalized therapies obsolete overnight.
High risk of being leapfrogged.
Very high.
Okay, finally, operational and macroeconomic risk.
Right. Manufacturing these autologous CAR-T therapies, the personalized ones, it's incredibly complex and expensive.
Well, didn't they sell their facility?
They did.
Yeah.
Mustang sold his own manufacturing facility for just $1 million simply to raise cash.
Wow.
Which then increased its dependence on third-party contract manufacturers.
Yep.
Adds complexity, potential delays, loss of control.
And there's a new macroeconomic risk, too, from April 2025.
Yes, the imposition of U.S. tariffs, including a 10% baseline tariff on most imported goods.
How does that affect a biotech like Mustang?
It directly exacerbates their primary financial risk. It increases the cost of manufacturing their clinical trial materials, many components of which might be sourced internationally.
So it pushes their costs up.
Which raises their cash burn rate, shortens their already precarious cash runway, and just accelerates the timeline to their next highly dilutive financing. It's a vicious cycle that makes their financial tightrope walk even harder.
Okay, that's a lot of risk.
Yeah.
Which brings us to the final chapter, Chapter 7, Synthesis and Value Investing Thesis. This is where we bring it all together. Try to form a coherent investment decision.
Yep, the moment of truth.
So, the bull case for Mustang Bio, you might call it the deep value lottery ticket case, right?
Yeah, that captures the feel of it.
It basically hinges on this enormous disconnect between its tiny $5.21 million market capitalization and the multi-billion-dollar potential of its therapies if they work.
Right. The argument goes like this. You've got compelling science, you've got some encouraging early data, You have a CEO with direct, successful CAR-T experience.
That Novartis background.
Exactly. And you have that recent orphan drug designation grant, which is a tangible positive step. A probabilistic RNPV model, even with conservative inputs, can show that if even one of their programs succeeds, the intrinsic value could be multiples, many multiples of its current price.
So from that narrow perspective, the stock isn't just cheap.
It's priced for near certain failure, which means if the science works out against the odds, it offers a potentially massive margin of safety. That's the lottery ticket argument.
Okay, however, then there's the bear case, which the analysis calls the value trap. And this case seems far simpler and frankly more grounded in the current reality.
It really is. This is a company teetering on the verge of financial collapse. It has an unacceptably short cash runway. Survival is not guaranteed, even in the short term.
And the lack of smart money.
That near-total absence of sophisticated specialist biotech investors is a damning verdict. It strongly suggests that those with the deepest expertise have looked at this and deemed the risk-reward fundamentally unattractive.
Plus all the other risks.
Immense clinical risk, that 85% plus failure rate, conflicted governance due to the fortress entanglement, and an ownership structure and volatility that just scream speculative trading instrument, not stable long-term investment. This bear case is simpler, more powerful, and it's grounded right now in the company's actual financial statements.
So what does all of this mean for that concept of a margin of safety, especially for a value investor? How should we think about it here?
Yeah, this is crucial. A true value investor, following the principles laid out by Benjamin Graham, seeks a margin of safety that includes two things. One, a low price relative to intrinsic value, the cheap part.
Which Mustang arguably has, quantitatively.
Arguably, yes, based on that blue sky potential. But the second part is just as important. A resilient underlying business that's capable of surviving future uncertainties long enough to actually realize that potential value.
And Mustang fails that second part.
Miserably.
Yeah.
It fails this crucial second test. While it might look quantitatively cheap compared to its lottery ticket potential, its financial position is so fragile, so precarious, that the risk of permanent capital loss, losing everything, is unacceptably high for a value approach.
So the investment thesis is basically binary.
Completely binary. It's either a home run or a complete strikeout. There's very little middle ground. And that is the domain of a venture capitalist who builds a portfolio expecting most bets to fail.
Not a value investor.
Not a value investor, whose first rule famously is don't lose money, and whose second rule is don't forget rule number one. That orphan drug designation, while a tangible step forward, it doesn't change this fundamental gamble.
It just buys them a chance to raise more money.
Exactly. It merely provides an opportunity to raise more capital, likely diluting shareholders further, to continue placing this very high-risk bet with other people's money.
Therefore, pulling it all together, the final recommendation based on this deep dive analysis is a clear avoid.
Avoid. The risks simply outweigh the potential rewards for a prudent investor.
Wow. Okay. That was a deep dive into Mustang Bio, Inc., MBIO. It really revealed this profound tension, didn't it, between that groundbreaking scientific promise and the stark, brutal financial realities.
It really did.
It truly makes you think, how do you balance the allure, the hope of potentially life-saving therapies with the cold, hard realities of financial viability in these highly speculative sectors like biotech?
Yeah, it raises an important question for you, the listener, to consider. What really stands out to you about how that clinical potential gets weighed against financial stability? It just underscores that understanding the business quality, the financial health, is absolutely as vital as understanding the technology itself. Maybe even more so sometimes.
Absolutely. Well, if you found this deep dive valuable, we definitely encourage you to like and subscribe to Stock Analytics AI.
Please do.
For just $4.99 year 9, members get priority deep dives on specific stock tickers you request. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those analyses.
That's a huge undertaking covering the whole S&P 500.
It is. And if you just want a one-off deep dive on a company that interests you, you can always drop us a super thanks on the platform.
Yeah, we appreciate the support. And as always, a reminder. This deep dive was powered by AI analysis of publicly available data. While we strive for accuracy, you have to remember that investing in securities, especially in clinical stage biotechnology companies like Mustang Bio, carries inherent risks.
Very high risks.
Including the potential for total loss of your principal. This report, this discussion, it's for informational purposes only. It does not constitute an offer or recommendation to buy or sell any security. Always, always conduct your own due diligence.
Couldn't say it better myself. Thank you for joining us on this deep dive. Until next time, keep learning and stay well informed.